Oil hit $107 a barrel on Monday. That is not a typo. Brent crude climbed another 1.5% over the Anzac Day weekend after the United States canceled diplomatic talks in Islamabad, leaving the Strait of Hormuz crisis with no visible exit. By any conventional logic, that should have been a tailwind for Australian energy stocks. It was not. The ASX 200 closed down 0.23%, its fifth consecutive losing session. That alone is notable, but the headline number hides what was actually happening inside the index. While Wall Street's S&P 500 and the Nasdaq were printing all-time highs on the same day, the Australian market was struggling to find a floor. The gap between the two has become impossible to ignore. Energy was the story no one wanted to tell. Woodside fell 1.72%. Santos dropped 1.86%. Whitehaven Coal slid 3.41%. Yancoal was off 2.30%. The sector as a whole fell almost 2%, in a session where oil futures were rising. Origin Energy was hammered 5.25% after its March quarter update. LN2 production from Australia Pacific LNG was down 2.7% quarter-on-quarter, and the previously high-flying Octopus Energy investment, the UK retail energy business that had been a growth story, came with a downgraded earnings forecast. Origin now expects its share of pre-tax earnings from Octopus to range from negative $70 million to positive $30 million for the current financial year, versus earlier guidance of $0 to $150 million. Utilities fell nearly 3% on top of that. The defensive sectors, staples, financials, telcos, all drifted lower. And somewhere in the middle of all this, gold stocks surged and lithium names caught a bid from Chinese futures. Newmont jumped more than 7%. Pilbara Minerals added 2.17%. IGO gained 4.7%. The market was not down evenly. It was fracturing.
Here is the thing about Australian energy stocks and oil. The relationship was never as clean as the headline suggests. Origin Energy's problem on Monday was not the oil price. It was the lag. Global LNG export contracts are priced off oil with a delay, typically 3 to 6 months. The $107 Brent that traders are pricing today will not show up in Origin's realized LNG prices until FY27, as the company itself acknowledged. So, when investors looked at the March quarter numbers, they were looking at results locked in before the Middle East crisis fully escalated. The revenue hit from lower LNG volumes and the Octopus downgrade were both visible and immediate. The oil upside is still theoretical. That creates a specific kind of pain for energy holders. You own a stock that should benefit from $107 oil, but the benefit does not arrive for 6 months. Meanwhile, the operational miss hits today, the guidance cut hits today, and rates are about to hit today too. The Reserve Bank of Australia meets next week, and the expectation is another cash rate hike, what would be the third in a row. Utilities and yield-sensitive names are already pricing in that pressure. That is why the sector that should be celebrating $107 oil is instead selling off. The timing mismatch is the mechanism. There is a harder question underneath this, though. Data centers drove a 4% increase in Origin's electricity sales volumes in the March quarter, the largest year-on-year volume jump in recent memory for the retailer. Origin is betting its grid strategy on becoming the preferred power supplier for Australia's AI infrastructure build-out, a theme reinforced by Microsoft's announcement of a $25 billion supercomputing investment in Australia over the next 3 years. If energy demand from data centers keeps accelerating, the Arene coal plant that Origin has twice delayed closing, now pushed to 2029, becomes a strategic asset rather than a liability. That is the bull case. The bear case is that none of this matters if the RBA hikes again next week and the broader market reprices yield-sensitive assets lower.
5 consecutive down sessions for the ASX while U.S. markets are at all-time highs is not a routine event. It has happened before, most recently in periods when domestic rate sensitivity and offshore capital flows diverged sharply. In 2022, the ASX held up relatively better than the US for the first part of the rate cycle because of commodity exposure. The dynamic now appears inverted. US tech earnings are driving Nasdaq highs, while AU's resource and energy mix is being weighed down by rate fears that are more acute here than in the United States. The IFM bid for Atlas Arteria, a $7.4 billion unsolicited offer representing only a 10% premium to last close, is its own signal. Atlas Arteria jumped 13% on the news. IFM is owned by 15 Australian industry superfunds. They are, in effect, Australian retirement savers bidding to own the toll roads that Australian drivers use. The fact that the offer came in at only a 10% premium, and Atlas Arteria's board immediately flagged that it was only 10%, suggests either IFM sees deep value that the market has been missing, or that they are willing to walk away and the premium will need to rise. The deal is not done. Gold and lithium are the two sectors that currently do not care about either story. Newmont's 7% surge reflects a global bid for real assets as the Iran crisis persists and sovereign debt concerns grow. Lithium's lift is coming from Chinese futures, up 3.1% on Monday to 183,280 yuan per ton, a 56% increase since January. That is a Chinese demand signal, not an Australian one, but Australian lithium miners are the proxies. The current evidence leans toward the energy sector remaining under pressure as long as the RBA is hiking and LNG contract lags persist. Both are likely conditions for at least another quarter. If the RBA holds at next week's meeting rather than hiking, that changes the calculus for utilities and yield-sensitive names immediately. The benchmark to watch is the May 6th RBA decision. A hold would likely trigger a sharp reversal in the names that fell hardest Monday. A hike extends the pattern. The harder variable is whether the Hormuz crisis resolves before the oil price benefit flows through to Australian LNG earnings. If it does, Australian energy stocks will have taken the pain without receiving the gain. If it does not, if $107 oil is the floor, not the ceiling, then the lag effect becomes a 6-month time bomb of upside that the market has not priced. Which one it is depends on a conflict that no one in Sydney or Melbourne controls.